Hello and welcome to the Energy Connect studio at the 9th OPEC International Seminar in Vienna. I'm delighted to have sitting next to me in the studio today, Simon Flowers, Chairman and Chief Economist at Wood Mackenzie. Thank you so much for joining us here at the Energy Connect studio. It's great to have you back.
Well, it's super to be here.
Thank you. To start off, what would be your impressions about the oil market, especially in light of all the recent activities and the sort of volatility that we've seen? What sort of temperament do you see playing out over the long term?
Well, you use that word volatility, and I suspect it's going to remain pretty volatile for some time. I don't think we've seen volatility like this for a long time. So we've had geopolitical tension, which has pushed the price up over $80 at times this year already, twice in fact. And we've had maybe more supply than demand than expected, which has pushed Brent down below $65 twice. And at the moment, it's sitting somewhere in the middle. There's so much going on. I mean, number one, the geopolitical tension isn't going to go away, and that's going to help support prices. Number two, the fundamentals have been changed by OPEC Plus decision to push oil out into the market faster perhaps than we all thought 6 to 9 months ago. And so I think we're moving into a period where OPEC Plus is trying to balance the market, but it will probably run into some seasonal challenges. So at the moment, the $70 price is suggesting that there's enough demand to absorb it. As we go through summer and we move into the winter, demand will fall again. And I think there's a risk we might see prices quite a bit lower, all things being equal.
Now, at the opening ceremony of the OPEC seminar this morning, we heard the need for more investment and how the sector suffers from chronic underinvestment, and without which we are like sleepwalking into an energy crisis, to use HRH's words. What are your thoughts on the requirements for investment in the hydrocarbon sector?
It's a very good question. Let's talk about the immediate impact of lower prices. So we've had oil prices averaging over $80 a barrel for 3 years in a row. It's been a stable environment, and investment in upstream oil and gas has been increasing quite fast actually since the low point 4 years ago. Well, it's going to hit the buffers this year, and it's probably going to be down because the last thing companies want is uncertainty. So it's uncertainty in price, it's uncertainty in the global economy because of tariffs, all these sorts of things. So I think in the short term investment will fall, and it's probably going to be, it's already becoming evident with slower run through of FIDs, with US lower 48th rig count falling. So in the short term, we're going to see investment falling, and particularly into 2026. And I think it's just storing up problems for further out. That was a message that was coming out this morning. It's certainly one that we believe in, that oil and gas demand will actually be pretty strong. You know, we need those things for energy security. Even though the price is volatile, at these sorts of prices, say between $60 and $80, is an affordable form of energy. So we're going to need a lot of investment in new supply around the time of 2030. I would anticipate we're in a sort of awkward period of readjustment as OPEC Plus manages the market, getting its oil into the market. But then we could see quite high prices come back if demand stays high, as we think it will.
That's an excellent point about demand. And one of the things that we've seen drive up demand in recently and also in the forecasts is the rise of AI and data centers.
Absolutely, and you know, had we talked maybe 18 months ago, it just would not have been on the agenda, but it's now a massive thing. So it's going to drive electricity demand up. They want clean energy, but they won't get, when I say they, I mean the tech companies, they want clean energy, but you know, it's not really available in the form that they want. They want large loads, and the only thing that can really supply that is fossil fuels, and it'll be mainly gas. And if we focus on the US, which is maybe most evident here, because you've got all the data companies there, the tech companies there wanting to build the data centers, They would love to build nuclear and have a dedicated plant. They'd love to do geothermal, but these things are just so far in the future. You know, nuclear is not too far off, but it's still 10 years by the time you build it. So you just have to buy power off the grid, and the only way really you can get consistent power there is with gas. It'll be complemented by a bit of coal. Renewables will play a part, but gas is the one that will balance the market, give them the steady 24/7 supply that they want. And that has all sorts of ramifications. It does influence, more gas demand from power does influence the way oil is produced, because a lot of that gas in the US comes from associated gas with lower 48. But the principal thing I'd say is it's probably going to keep gas prices up. Most people think that gas prices are flat as a pancake for the future. That's actually what the forward pricing. But we believe that very strong demand is going to suck gas out of the US shale plays more quickly than we thought before, and get the price of gas could be up by 50% by 2030 in our view.
And finally, we are here at the OPEC seminar in Vienna. What are your thoughts? What are your takeaways? And how's Wood Mackenzie engaging with this event?
Well, we're engaging in a big way. We are one of the sponsors. I'm glad to say we have a booth, and the people who are here, wholly justify that investment by us, because we've seen the kings and queens of the industry up on stage this morning, the ministers, the CEOs, and there's been a terrific discussion. There is, I'd say that the oil industry itself believes in the future of oil, and we heard a number of people talking about oil demand being above 100 million barrels per day, which is roughly where it is today. It's about 104, 105 at the moment, but maintaining at over 100 million barrels per day for the foreseeable future. And that's something that 5 or 6 years ago many were doubting. We thought electric vehicles would come through quickly, would start to disrupt the oil market. Well, it's not happening now. It's not to say it won't be happening in 5 or 10 years' time, but it's definitely not happening now. And in a way, I think that's a good thing, because we're going to need more investment in oil, and notwithstanding the uncertainty that's taking investment out at the moment, the fact that there's a degree of consensus and belief that oil demand is going to be fairly resilient gives the industry quite a bit of confidence to keep exploring, keep developing the discovered resources that are there already, so that there's enough supply to keep oil affordable into the 2030s.
That's an excellent point, and as we heard His Excellency, the Secretary General, OPEC Secretary General, said this morning, with the new World Oil Outlook out tomorrow, updated version, there will be a few surprises. Let's see where it takes us in terms of demand.
Yeah. I'm looking forward to hearing those surprises.
Simon, it's such a pleasure to talk to you always, and thank you very much for joining us in the studio today.
Not at all. Thanks for having me.
Thank you. Thanks for watching, and you can get more studio interviews like this and comprehensive coverage of the energy industry at energyconnects.com. Don't forget to follow us on social media, and I'll be back with more studio interviews from the OPEC International Seminar in Vienna. Stay tuned.